JPX Energy Market Weekly Updates. Crude oil futures last Friday were trading higher on the day but facing sharp weekly losses, with oil benchmarks near to one-year lows. The contango structure has also deepened as market turns to short-term oversupply. Focus of the week has been largely on the wider economic negatives as global economy's health came under close scrutiny, prompting further concerns over a deteriorating crude demand outlook. In last week's report, the EIA said U.S. commercial crude oil stocks declined 5.19 million barrels in the week to December 2nd, putting stocks 9% behind the 5-year average for this time of year and at the lowest outright level since mid-April. However, high price seems to have started to weigh on diesel demand in the United States. Deliveries fell for a fifth straight week to 3.55 million barrels per day, 12% below the 2015 to 2019 average. This is also the implied demand levels last seen during the pandemic year of 2020, when COVID restrictions kept a lid on economic growth. Distillate inventories comprising diesel and heating oil built for a fourth straight week as early December demand tumbled while refinery output stock closed to 2020 highs, with utilization rates pushed to 95.5% as some refineries went offline. Refineries continue to favor distillates over light ends thanks to relative solid refining margins, with output rising to its highest level since mid-July at 5.33 million barrels per day. U.S. distillate inventories are still below the 5-year average, but the gap in stocks compared to the previous year has slowly started to narrow. In its December short-term managed outlook, the EIA expects the combination of a slight contraction in the U.S. economy and refinery maximization of distillate fuel production reduced distillate prices in the first half of 2023. This is the cause of declining refining margins. The EIA forecast that U.S. diesel refining margins will fall by 19% in 2023 compared with 2022. However, the EU's ban on seaborne imports of petroleum products from Russia creates supply and price uncertainty for distillate markets in early 2023. Diesel and gas oil stocks in the northwest European hub of Amsterdam, Rotterdam, and Antwerp sit at 1.72 million tons, almost 25% below the 5-year average late November, and their lowest since 2008 for the time of year. Given relative low global petroleum inventories and necessary time and magnitude of inventory builds needed to replenish them, the market has limited slack during the forecast period, and any unplanned supply disruption has the potential to increase oil prices quickly and significantly. Meanwhile, in the financial markets, U.S. Treasury bond yields marked the widest inversion in 40 years amid recession fears. When investors are extremely worried about the financial future, it can lead to what is called an inverted yield curve. An inverted yield curve is where investors pay more for short-term bonds in the long term, indicating they do not have confidence in the long-term financial conditions. Historically, the yield curve has inverted before each of the last 5 U.S. recessions. In Asian markets, China announced on Wednesday the most significant relaxation of its COVID-19 prevention and control protocols since the pandemic erupted 3 years ago. The relaxation of rules, which include allowing infected people with mild or no symptoms to quarantine at home and dropping testing for people traveling within the country, are the strongest sign yet that China is preparing its people to live with the disease. Most analysts expect the path for China to reopen may take a few months, and initial reopening is likely to create a drag on the economy due to temporary shortage of labor supply and increased supply chain disruptions, with a surge in infections likely. Data also show on Wednesday that China's crude oil imports in November rose 12% from a year earlier to their highest in 10 months, as companies replenished stocks with cheaper oil and as new plants started up. However, imports for the first 11 months of the year totaled 460.26 million tons, down 1.4% from the corresponding period last year. Refined oil product export reached 6.14 million tons, the highest since June 2021, and up 4.46 million tons in October, reflecting China's additional releases of quotas. China's export of refined products are expected to rise further to 6.5 to 7.1 million tons in December. On the supply side, the Canadian pipeline owner-operator TransCanada Energy had shut in its 622,000 barrels per day Keystone pipeline system following a leak in Kansas. The line is a critical artery shipping heavy Canadian crude from Alberta to refiners in the United States. It's connected to both the U.S. storage hub in Cushing and to the Gulf, where it's processed by refiners or exported. The initial spike following the Keystone pipeline news was short-lived, but with WTI prices so close to $70 a barrel, we might not see much more weakness. The $70 level remains key for oil, as that is where Biden administration expects to start consider refilling the strategic petroleum reserve. Traders have also been monitoring the shipping situation, with over 20 vessels carrying 14.4 million barrels of CPC crude snarled around Turkey, waiting for passage into the Mediterranean via the Bosphorus and Dardanelles Strait, amid an ongoing stalemate between the Turkish authorities and shipping insurance over Turkey's demand for appropriate insurance letters due to Western curbs on Russian crude exports. The demand for even lower delivered values is heaping additional pressure on Euro's FOB differentials due to rising freight and demurrage costs. However, Russia will consider slashing its output, according to President Putin. There are still enormous unanswered questions which shape the impact of measures on the oil market, including the depth of non-European insurance markets, the appetite of some tank owners to participate in trade with Russia, and exactly how effective enforcement of the price cap can be. Okay, that's all we have for this week. Welcome back next week.